The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it is time to talk about money. Once again, we've got a lot to talk about today. There's things that are going on that are well worth your interest and understanding. You know, and it was just 30 years ago that we had the plunge in the market. The market went down 508 points in one day. That week, the following week, there was a wholesaler that came into the office and said, you'll be able to go into Nordstrom's and hear a pin drop. $1 trillion is gone out of the economy. So I went to Nordstrom that weekend. And I'll tell you all about that later in the program. We've got a great guest today. You want to hear what he has to say? But I want to start talking about my industry. I don't talk about my industry very often, but there's a couple recent studies that shed a lot of light on what's going on. I started in 1986, but going back before 1986, going back to May 1st on 1975, commissions were fixed. When you bought a stock or sold a stock, those commissions were fixed by regulations. But the government came along and deregulated commissions, allowing commissions to go. So the brokerage houses chose to do 100% of the market rates, just continue what they had been doing. They thought there was going to be very little impact into commissions at all. But there was a guy by the name of Charles Schwab who had a different idea. He had an idea that he could start a discount brokerage business and build it into something. 1975, he began with zero. But by 1999, 33% of brokerage clients, big brokerage clients, small brokerage clients, with brokerage firms, without brokerage firms, but 33% had at least one discount brokerage account. That was a very significant change. My industry didn't foresee that impact. They didn't see that the discount brokerage house was going to grow up. They looked at Charles Schwab as being some kind of almost crazy guy, that he was going to try to do this and do it automated when the brokerage houses had been around for a long, long time. They knew how to do the brokerage business. They knew what it took. It took a financial advisor, stockbroker in those days, took a stockbroker, and even before stockbrokers, it was a customer's man. They knew that that advice was really important to their clients. And they doubted that the clients would go off on their own and do it on their own because it's such a specialized business. And you need so much information. How could somebody just, for a lower price, go off and do it on their own? Well, they were proven wrong. And you ended up with the discount brokerage houses growing up. That was a really significant change. And by 1986, when I licensed in June of 86, still on the brokerage side, the brokerage houses still had a very, very significant share of the market. You had two things going on at the time. You had the discount brokerage business, but you had the regular with the stockbroker, a name that would be changed after 1987 to financial advisor, financial consultant. They didn't want to call us stockbrokers anymore. That was a bad name after 1987. But they also realized that their margins were not very good, and they had a number of low-producing brokers. So the average income in 1986 was around $43,000. That's for a family A U.S. family, that was the average U.S. family income of $43,000. But the brokerage houses began to dismiss and get rid of brokers who didn't produce at least $75,000 to $100,000 in revenues. Unless you were making $75,000 or $100,000, the brokerage houses didn't really want you to be part of who they were. And so what happened is you began to have some low-producing brokers going off and licensing as registered investment advisors. Now there's two acts under which stockbrokers or financial advisors, financial consultants, whatever you want to call us, there's two acts under which we fall. One was the Securities and Exchange Commission Act of 1932, which set up broker-dealers. Broker-dealers are what the big firms are. The Merrills, the Morgan Stanley, the Wells Fargo, the RBC, those are all broker-dealers. The idea was they could be a dealer in securities, but they were to broker the securities so that they were actual sales. And there were a set of rules that governed the financial advisors, the stockbrokers, the actual term is registered representatives, what they could do. And they were to make recommendations that were suitable for their clients. That was the key thing. It had to be suitable. Didn't say anything about being in the best interest. It had to be suitable. Didn't say anything about a fiduciary responsibility. The recommendations simply had to be suitable for the client. Had to meet the client objectives, risk tolerances, but it only had to be suitable. Between two investments, if two were suitable, they could choose the one that had the higher commission. That was the way that was. And 95% of the industry actually were employed by the broker-dealers. Just a very small percentage spun off under the Investment Company Act of 1940. Those were registered investment advisors, carried to a stricter oversight. They were responsible, and every decision they made for clients had to be in the client's best interest. They were fiduciaries. They could be sued if they made a decision not in the client's best interest. But very, very few actual financial advisors became RIAs. That was in 1986. But as time has rolled along, between 1986 and now, what's happened is that channel of registered investment advisors, those fiduciary brokers, financial advisors, that has gained momentum. It's no longer the people that the brokerage houses didn't want. They were the pioneers. They were the ones that went off and started this whole movement. But now you have large producing advisors who want the independence, who are more concerned with their clients than with their firms. And so what's happened is that channel has grown dramatically. Cerulli just released a report in the last couple of weeks saying that last year that channel grew by 6%, whereas the large brokerage firms were down 1.6%. Cerulli is predicting not only is the registered investment advisor channel growing faster, but by 2019, they're predicted to create more revenues and have more assets under management than the major brokerage houses. Major brokerage houses had 95% of the market in revenues and in assets under management. Today, it's approaching 50%. And within a year and a half or so, it's expected to be 50-50 or maybe favoring the registered investment advisors. You know, part of that is, and I worked for brokerage houses. I started with Payne Weber, which is now UBS. I went to Dane Bosworth, which is now RBC. Then I was recruited to Evron, which was bought by First Union, which was bought by Wachovia, which joined with Prudential Securities to become Wachovia Securities, and today is owned by Wells Fargo. through that whole process, those 18 years, I worked for those brokerage houses. So I've been on that side of the business. I've been there and seen what they do. That is a model which has tended to lose market share, and I believe it's going to continue to lose market share. But the other thing that's going on is we're starting to see the advent of the RoboAdvisor, and I think that will make a difference. But if I go back, before we talk about the RoboAdvisor, and we'll come back to talk about the RoboAdvisor very shortly, but if you look at some of the studies that have been done, Dalbar does a report every year on looking at the average mutual fund investor and how they do. And those include people that do their own work and those who are getting financial advice. And the average equity advisor for the past 30 years has averaged 3.69% versus the S&P 500 of 11.11. What that means is the average equity investor, the average person investing in stock mutual funds, has seen over 30 years 100,000 grow to 286,000, but the market, if they'd been just doing the market amount, would have grown to $2 million. That's a significant difference. We're going to come back and talk about one of the other changes that are going on and why you should be concerned about it. Don't go away. We've got a great guest coming up, and I want to talk about October 19th, 1987.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about the financial industry, the one that I'm in, because at one time the big brokerage houses, the Merrills, the Smith Barneys, the Morgan Stanleys, they owned the market, almost 100%. And the first thing that happened is the discounters came along, the Charles Schwab set up his shop, and they took about a third of the market away from them. And then they have lost another half of what they had to the registered investment advisors. But now I believe that both are going to be pressured by the RoboAdvisor. When you look at the performance of most financial advisors, whether they're in the registered investment side or whether they're in the broker-dealer side, the registered representative side, they're putting together portfolios which have significantly underperformed for the most part. The big brokerage houses, I spent 18 years in the big brokerage houses, and their mantra was always the same: sell the personality, not the performance. Sell yourself as being a wonderful person. Don't talk about how well people are doing. You know, that's coming home to roost. Those were the Dalbar numbers that I mentioned before. Dalbar that does the study that shows how people have done over the last 30 years. Over the last 30 years, they would have turned 100,000 into 286,000, which sounds not too bad until you realize that the market, if they'd invested just in the market, it would have been over $2 million. I think that there's something going on beyond that's going to put another squeeze in. The reason why fees were coming down when I started doing fee-based accounts, the charges were pretty standard across the board, that for the first 100 to 500,000, somewhere in that range, people were charging 3%. But with a poor performance, it's hard to justify 3% when the account's only doing 5%. That's very difficult to understand. So the fees have been coming down. They're coming down to around 1% and some significant below that. But now you have something new that's happened in the last couple of years, the RoboAdvisor. And you hear financial advisors talking about it. They don't think that it's going to cut into the industry very much. I think they're dead wrong. I think they're very, very dead wrong. There have been new studies that have come out. And while the big brokerage houses and a lot of the RoboAdvisors have seen that their focus is primarily on millennials, that was the target. The fact is, what we're seeing is something that goes way beyond that. My private banking just completed a survey not too long ago showing that 70% of high net worth investors, those with $5 to $10 million in investable assets, 70% thought automated financial advice would be helpful. 49% of high net worth are considering using a RoboAdvisor. BlackRock also did a recent study in which they found the reasons why the high net worth people are talking about using a RoboAdvisor is, number one, 42% labeled it was convenient, it would be convenient. 32%, a third, said it sounded like it was going to be a lot simpler. 30%, 3 out of 10, said there's going to be no product push. Over a quarter said the cost would be lower, and that mattered to them. 26%, or another 21 out of 4, said there would be more choices than they had now. And for sure, a RoboAdvisor is going to be able to look at 10,000 mutual funds, not a limited number that you'd find in most doing. A quarter also said it was going to be more objective advice than they're getting now. And 1 out of 5 said it would be in the client's best interest, and they had concerns that their financial advisor was not making decisions in their best interest. 1/5, 1 out of 5, said they would get better advice than they were getting from their personal advisor. Those are the high net worth people. Those are the bread and butter customers, clients for the big brokerage houses and for the registered investment advisors too. The question is, what does the financial advisor bring? What does it really mean? If you look at what most financial advisors do, they set up a financial plan. All you're doing is sticking data into a computer and the computer spitting out information. When I set up my firm in 2005, I thought we were probably going to do financial planning. We bought the very best financial planning software we could get. We plugged it in. The first report came out. It was 400 pages long. 400 pages long. All sorts of graphs and charts. And as I dug through the whole thing, I realized I'm a mathematician. And as I looked at the math and the assumptions underlying this, I realized how inappropriate, how wrong it was. Garbage in, garbage out is the old phrase. And that financial plan is really garbage in and garbage out. And we found that out in 2008, 2009, when a lot of financial plans went haywire. But RoboAdvisors are going to be able to do that. They're going to take the very same information. They're going to be able to plug it into that software and spit out a financial plan just like a financial advisor does. Financial advisors will then, once they have a financial plan, will make recommendations on mutual funds, and they'll look at a limited number because as a human being, we have a limited amount of time RoboAdvisors are going to examine 10 or 15,000, I don't know how many mutual funds exist today, but over 10,000. They're going to be able to look at a selection of 10,000 and pick the very best ones. The same goes for separately managed accounts. Financial advisors go through this whole process, and the firms do a criteria to say this is a good separately managed account where they can actually follow and do the compliance work. RoboAdvisors are going to find the same thing, and they're going to be able to examine far more. They're going to be able to do greater due diligence and greater tracking because it's all going to be automated. Rebalancing, rebalancing is a computer selection. All those things are going to be done by RoboAdvisors at 1/10 of the current cost. If the current cost is 1% today, RoboAdvisors are probably going to do it at 0.1% and do it better than it can be done by financial advisors. And the thing, personal meetings, meeting in person, well, that's going to be difficult with a RoboAdvisor. But then you have to look at the cost. And I believe it's the same thing as the beginning with the discount brokers when the brokerage firms felt that people were not going to go with discounters because they wanted that personal connection with the financial advisor. They lost 1/3 of the market because of that. So the other thing is the big brand. What does the big brand mean? What does it mean to have a big brand? I mean, those were the same firms that almost went under. And some. Merrill was bought by Bank of America. You look at the firms that were purchased because they were going under, the banks that were going under. Wachovia went into Wells Fargo. Does the brand really matter that much? There are some high net worth people who have very complicated wealth management things. But even there, you have a specific area, the family office, which is set up to address that. For the most part, it's not going to be with most financial advisors. The RoboAdvisor is coming. If you look at what happened, Vanguard launched a RoboAdvisor in 2015. They collected $7 billion in assets. In 2016, the assets had grown to $51 billion. We're seeing that happen. We're seeing it happen on the squeeze. And even the big firms, the Merrill has launched a RoboAdvisor. They're cannibalizing their own financial advisors. The industry is going through a lot of changes. In my opinion, if financial advisors are going to continue to exist, continue to work, you have to have a value proposition. Unless you can perform somewhere in the neighborhood of the S&P 500 or outperform it, you're going to be eaten by the RoboAdvisors. My focus has always been on the Standard & Poor's 500, a straightforward thing. We measure ourselves against that. We measure our client performance against that. And net of all fees, we want to be superior to the Standard & Poor's 500. That's the value proposition we've operated with for 12 years, and successfully. But I believe that the industry is going to change, and I believe it's only a matter of time until an Amazon or a Google or an Apple or one of the big firms decides to get into the RoboAdvisor business, and that's something that won't be slowed down at all. We're seeing a huge change in the industry, and you should be prepared, and you should be prepared with your financial advisor, because that person may find their business dwindling to almost nothing. So that's where I am today. We have just a little bit of time before the break, so I want to introduce my guest today. My guest is Marty Roberts of Wickets Labs. Welcome to the program, Marty.
Thanks for having me.
So we're going to come back and talk about your background. We're going to come back and talk about Wicket Labs. We're going to talk about your industry right after the commercial break. But don't go away. You can find us on Facebook. You can like About Money. You can find About Twitter, About Money. So don't go away. We've got a lot more coming, and we want to talk about October 19th, 1987.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Get away. Get a good job with your pen. You're okay.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
Welcome back, and I'm here with Marty Roberts of Wickets Labs. So, is it Wickets Labs?
It's Wicket Labs.
Wicket Labs. I wrote it down wrong.
That's all right.
So, why don't we start with your background?
Sure. Yeah, so Seattle native, kind of grew up here, went to the UW. Started actually in technology in 1996, working for a company that changed its name shortly thereafter to Real Networks. So really in the early phases of digital media on the internet, we defined streaming media really for the industry. Worked for that company kind of throughout my early career, and then left that company and did some other startups. In 2006, I joined a company called The Platform, just as it was being acquired by Comcast. And the mission of the platform was to help big media companies get their videos online and set up for all the new digital destinations that they wanted to push that to. So at first it was their websites, and then it was mobile phones, and then it was Roku devices, and you kind of name it. And eventually we even started pushing content back to the traditional TV as well, as the traditional cable industry started to migrate to more of a digital first mentality. Left that company about 2 years ago, and then shortly earlier this spring started Wicket Labs. And so Wicket Labs is back in that same media space, working with those same big media companies. And yet our mission is very different. It's really to understand and essentially become the big data department for these big media companies. So understand all the big data that comes in from lots of different sources and help them make better decisions about their programming, about what shows that they want to produce, about how their viewing experience is, so that they can really make a good informed decision based on who that audience is. It's actually a lot like, as you were talking about, the equivalency of a RoboAdvisor, except now for your TV experience, whether that's on your Roku device or on your TV itself.
So when you talk about this industry, for a long time there were 3 networks, ABC, CBS, NBC, and over a whole period of time, that's who dominated. And then you began to add a few channels. And today there's 400 channels come through, and
more, yes.
400, 500, 700,
exactly,
whatever.
About 500. That's right. Yeah.
So that's been a big change, and it's been a lot of new entries into that space. When you look at what's happening.
That's right. And so we've seen this evolution of the TV industry, which has been really fascinating to follow. As you pointed out, originally it was just the broadcasters. And then in the 80s, the cable industry really came into its own. So we had the establishment of ESPN and CNN and Turner and these other Discovery, these other cable networks started to come together. And they started with 1 or 2 channels and then grew from there to be established content producers as well as networks that aggregate all of that content together and put it into a linear format that we watch on TV today. That evolved and kind of really has peaked, and has been kind of the mainstay of consumption for almost 30 years. But starting around 2010, and some would argue even earlier, with the proliferation of broadband into our homes, with better technology about how we deliver digital video over the internet, we started to see new ways of reaching your audience, and new broadcasters came up. So YouTube came out of nowhere starting in 2006, and I just read a statistic that every single day, another 1,000 producers, video producers, gain 1,000 audience members, and they cross that threshold. And so they're becoming their own micro broadcasters in that new medium. So, you know, it's been a huge evolution, and that presents a lot of opportunity, but also a lot of challenges for the traditional media companies.
And for some of the new companies, they already have all the data, right?
It's a big advantage for a new company when you look at a company like a Netflix, or you look at a Hulu, or even Amazon, as they're getting in now into more streaming video. They've built their technology from end to end. So the advantage they have is they have data at every point in that chain, in that distribution chain. So they understand what we watch and when we watch and how we watch and how quickly we find the video when we turn on their, you know, when we load up their app. All of those types of details inform their business and allows them to test and evaluate new ideas very frequently. So on any given day, they're always testing a new idea against a small segment of their audience. That gives us, and as that audience proves out to have a better experience, then it gets rolled out to everyone. And that ability to do that A/B testing, to use that data in a very strategic way to improve their experience, to improve their content, is an advantage they have over the traditional media companies, the traditional cable companies that are out there today.
Because the traditional companies never worried about their customers.
That's exactly right. Traditionally, if I was a network, either a cable network or even a broadcast network, you know, I didn't think as much about my audience as I thought about my advertisers. They were obviously very important to me. And then my distribution deals with my cable companies that I was working with. Those companies like Comcast and Charter and DirecTV. So, you know, as we look at those relationships and how they've evolved, the audience was always just assumed to kind of be there. Well, the cable company had, you know, Comcast had 20, 25 million subscribers in that range. You know, so if you wanted to reach those 25 million subscribers, you'd go through Comcast as a distributor. Now all the bets are kind of off. That's all changing. That's now as a network, I can choose to go through a classic distributor, and they have an audience and a billing relationship with that audience, which is a big advantage. But I could also choose to go direct and start to sell my services direct to those consumers without a cable company. HBO has done this right now. They're up to about 3 million subscribers with HBO Now, which is no cable company involved, HBO direct to a consumer, and they've established a new billing relationship with that consumer. It's a brave new world where HBO's never had a relationship with consumers before, and many other networks are following suit.
And by doing so, they begin to understand who is watching their program and what they want to watch and how they want to watch.
That's exactly right. They start to really understand who that audience is and develop a relationship with that audience and start to think about that audience in a way that's different than they've traditionally had. Before, when you were selling advertising against this content, you went off of kind of classic demographic data. I want to sell to 24 to 34-year-olds that might want to buy a truck. You know, that was kind of the target audience and things like that. But now we can go much beyond that with the data. We can actually get into personalities or personas. So we can say, hey, these are kind of your weekend bingers. You know, they really, during the week, they seem pretty busy. They don't watch much. But on weekends, they're going to watch 5-6 hours of content. You know, that might be a different profile. They might consume content differently. They might consume different types of content. And they might actually value different types of ads than a standard, you know, just kind of run-of-the-mill demographic-based targeting. And so you can get a lot of new, there's a huge advantage. You can get a lot of advantage from understanding that audience member a little bit better and starting to craft your experience, whether that's the user experience in how they discover content or what the content is or how you advertise around that content. It can all be a lot better if it's a little bit more data-driven.
And it's also something, you know, we're not big TV watchers at my house. Mm-hmm. But what we do watch, generally we like to watch without ads. And time is really important because we're very busy people. And so we don't mind waiting a day or two or three to watch a program. Yeah.
That's
if we can watch it without ads.
When you want to watch it, where you want to watch it. These are all really important considerations for any media or video service today, that traditional TV service. This really brings into, this brings all kinds of new elements into this, what was a pretty rock solid distribution chain, where value was really well established throughout the entire distribution chain. Now everything's up in the air. When to advertise, how to advertise. Would you be willing to spend a little bit more so you didn't see ads at all on your favorite channel? Some network families are trying that experiment right now. So what we have and what we're seeing is a lot of experimentation in this new environment. TV is going to be a very different experience in the next 5 years than it has been for the last 30.
So let's talk about Wicket Labs, because
Sure.
that plays right into what you're doing.
Yeah, so there's this real advantage where when you look at those new companies, as we talked about, Amazon and Netflix and Hulu, where they have this data all locked up that they can leverage and use. Traditional media companies have not had that advantage in the past. They've outsourced their technology to lots of different vendors. I sold my channel to a Comcast, but I didn't get any data back on who they were. That's all changing now. There's lots of data that's flowing in. And so what we do is we aggregate that data and then we present it back to the media business so they can really understand their audience better and ultimately improve the lifetime value of that audience member over time.
And it's going to make it more valuable for the consumer?
Exactly right. Because we can do is optimize things like, as soon as you load up that app experience, how long does it take you to find a show you want to watch? If we can minimize that by 20 seconds or 30 seconds, that's a better experience for you. That's all data in terms of how we try new ideas and how you discover content and see what really works.
So Wicket Labs has a key part in that whole thing.
We hope to be. We're a new company and we're just getting into the space, but we expect that if we move to more of a data-driven decision model for these video experiences, consumers are going to win and the media companies are actually going to make more money.
It's fascinating to see the changes that are going on, and it's an improvement all the way around.
That's exactly right. It's becoming a more consumer-friendly experience all around. And so as a result, and all the numbers show, we're actually watching more video than we've ever watched before.
Well, thanks for all that information. It's a real pleasure to have you on the program. And if people wanted to know more about you, they could go to your website?
Yep, wicketlabs.com, and we'll tell you all about it.
That's great. Thanks
Thanks.
very much.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I finished the last segment of the show by talking about a quote from Thomas Edison to George Westinghouse. Two great inventors, two people that fought over electricity, whether it was going to be direct current or alternating current, talked about the light bulb. You know, and it started our age of invention. These days of handcrafted miracles, they won't last much longer. Does that ever worry you? You know, but picture their time. Picture the transportation was a horse. It took days to go from coast to coast. It took weeks to go from the United States to Europe. You know, refrigeration was an icebox. You had people that went around in horse-drawn carts to deliver ice. You know, washing clothes was done by hand. Washing dishes was done by hand. There was no such thing as a microwave. That was the time they live in. Times change. The new book is one that was written by Robert Gordon of Northwestern University, and he's what I call the new Malthus. You know, Malthus was an economist that lived in the 1700s, and Malthus believed that they had reached a maximum automation for doing agriculture. He believed that the population was growing faster than the food supply, and that when that happens, he expected wages to go down. He expected that actual famines, he was for famines, epidemics, and wars, because that would reduce the population and make food more available. He was in favor of celibacy and marriage late in life so that you had fewer children. He argued against the poor laws, those that were meant to support the poor people. You know, and if you look at what farm productivity was, you know, in 1830, when he died, soon after his death, almost 50% of the U.S. population, had 23 million people in 1850, 50% of the population worked on the farms. You know, it was huge. Now, when you think about it today, we produce 600 times what we produced then. And we do it with less than a tenth of the people that we employed. The productivity gains are over 6,000-fold. But Gordon says we are living in a time when there were 3 cycles. From 1750 to 1830, there was the steam engine, there was cotton spinning and railroads, and that's what gave us growth in the U.S. From 1870 to 1900, we had electricity, we had the internal combustion engine, and the most important of the 3 was we had running water, and that led to another spurt of growth. From 1960 to the 1990s, we had the computer, but since 1900, innovation has slowed down, and we're entering a time of slow innovation, slow productivity, slow growth, and things are just going to barely move forward. All the great inventions have been done. Sounds very similar to what Thomas Edison said to George Westinghouse. Don't you regret the fact that all the inventions have essentially been discovered? And from here on, there's just going to be small improvements, you know. But Malthus wasn't the only one. John Kenneth Galbraith wrote a book called The Affluent Society in 1958, and The New Industrial State in 1967. He said Americans had reached the highest living standard they'd ever reached. Think about it. They were living in homes that were 1,100 square feet. That was the ultimate home size. They had 1 car per family. They had transportation. Large companies were producing 2/3 of all the output in the key sectors. The technical structure, the control of technology was with the large companies. Small companies didn't have the capital and didn't have the ability to compete. Large companies were able to take the risk. Small companies couldn't take the risk. Large companies were objective. They weren't to maximize profit, but they maintained the organizations. Those large companies and labor contracts controlled the suppliers, and they had the political influence. Those organizations were going to continue to dominate, and there was little room for small companies. You know, that was 1967. Think about it. Large companies would dominate technology. They had the money, they had the markets, they had the control, they had the politics. You know, we'd reached an ultimate in affluence. We were at the top. Now think of this, 1966, 1967, the companies that made up the Dow were Anaconda Copper, American Can, American Tobacco, Bethlehem Steel, Chrysler, General Foods, Goodyear, Johns Manville, Owens, Illinois, Swift and Company, Sears, the Texas Corp, Union Carbide, U.S. Steel, Westinghouse Electric, and Woolworth. Do you remember seeing a Woolworth lately? Have you heard of Union Carbide? You know, those small firms, those firms that didn't have a chance to exist, were firms like McDonald's came public in 1966. Small firm. According to Gilbreth, they didn't have the capital to compete, wouldn't go anywhere. You know, think of the companies that came since then. The Microsoft, Intel, Apple, Home Depot, Walmart, Southwest Bell, Qualcomm, Amgen, Genentech. Think of those companies that have grown up since then, those companies that they didn't believe would have the ability to grow and to mature. You know, don't buy that book. It's making an argument that George Westinghouse made, that Malthus made, that Gilbreth made. And it's an argument that we haven't even begun to see. You know, William Nordhaus of Yale said 70% of the goods and services in the year 2000 didn't exist in the year 1900. My guess is that 70% of the goods and services that exist in 2000, that will exist in 2040, don't exist today. Companies are changing faster. Just think about it in terms of the phone and computers and the things that are changed. Today we carry around what we call a cell phone, but it has more computing power than those huge computers that IBM was selling in the 1970s and 1980s. We carry around something that connects people worldwide. You know, a girl will wake up in Kenya, turn on Khan Academy, and study English or math. Someone in Uzbekistan will turn on their computer and tune in to a program that's running from South Africa. We've connected the world. Things are changing. We have only begun to see the changes that are going to happen. Edison was wrong. Gilbreth was wrong. Gordon will also be wrong. I believe you can count on that. And that wraps up the program for today. Got a lot more coming next week. There's so much going on in the world, it's hard to cover it all in 1 hour. But for next week, have a very great weekend and a great week. We'll be back next week to talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored